All right, let's go. Titanium Transport Group, symbol TTNM on the TSX. Let's go back there. Hold on. My mouse isn't working properly. There we go. Trades at around $2.32. Market cap is $103 million. Dividend is 3.42%. They are an asset-based logistic and trucking company that services over 1,000 clients, mainly in Ontario and adjacent regions. The company is a leading industry consolidator. It's done 12 acquisitions since its inception. Operations include cross-border truckload services, Canadian and U.S. freight, logistics, and warehousing and distribution services. Let's look at their Q3 results that were out last week. As we can see here, revenues dropped about 1% to $111 million. EBITDA was lower at $13.5 million compared to $15.5 in Q3 2022. Their EBITDA margin was lower at 13.6% versus 16% in the same period last year. The truck transport segment was actually up to $62.4 million compared to $54.9 million, but logistics was down to $51.5 million from $59.6 million. Diluted net income per share showed here at 4 cents per share versus 5 cents in the same period last year. However, when you normalize those, last year's was about 14 cents. So on a normalized basis, net income was down roughly 71% in the quarter. So let's look at some highlights from the quarter. They completed a strategic asset-based acquisition of Crane Transport out of Oakwood, Georgia, adding 200 trucks to two strategically located terminals in Georgia and Alabama, and approximately $60 million in top-line annual revenues, further expanding their North American footprint. They announced their 7th U.S. freight brokerage office was launched in Jacksonville, Florida as well. There's management comments from the quarter here. During the third quarter, our industry continued to face significant headwinds, including adverse economic conditions, soft demand, and overcapacity. That's from the CEO. And their guidance came out for the full fiscal year this year, 2023, about expecting consolidated revenue of $430 to $450 million, adjusted EBITDA margins from 10.5% to 12.5%. Give you some context here of that. This is essentially they lowering guidance. A sluggish freight environment caused the company to lower its annual revenue guidance to $430 to $450 million from $450 to $470 million, where it was previously. But the company is maintaining its EBITDA margin assumption of about 10.5 to 12.5% on lower revenues. So let's look at valuations. The forward-looking EV to EBITDA is 5.5 and the PE of 10. It appears attractive, but EPS is expected to be significantly lower. The estimate is around 23 versus 55 cents last year. So let's look at our take here. Lower CapEx in fiscal 2024 and 2025 is expected following 2 years of heavy CapEx, a replacement cycle, particularly exacerbated by delays brought on by the pandemic. Management noted on the call that they do not anticipate further purchases of trucks over the next few years. Their average age of the fleet now is 1.6 years, so that's quite low, and they have caught up with the trailer replacement cycle that they were in. CapEx is expected, for some context, at $14 million over the next 2 years versus $77.8 million in fiscal 2022, and an estimated about $55 million in this year. Given lower CapEx spend, management anticipates stronger free cash flow generation over the next 2 years. In our opinion, however, though, with debt expected, based on this year's expected EBITDA, that should say in the range of 3.5 times, the company will need that free cash flow to begin paying down debt more aggressively. This will be a priority. If we look at 10-year revenue growth on the business, it's fairly strong. You can see here, strong, consistent track record of growth. However, you can see in the last 12 months, it's been trailing off. So we see the final point here would be limited growth organically, particularly in the near term. Fair value, it's trading in a fair value range right now. It's about fair value. There's higher risk with a business like this in a recession. And that's how I'll close off on titanium.
It's an interesting company. We actually met with the management team down in Los Angeles at the Roth conference, and there's a number of companies in the trucking and logistics space that we do cover. But interesting though, for the first 3 quarters of last year, the industry had tremendous results, which was largely due to price increases and just demand outstripping capacity due to the supply chain issues. But then it changed very quickly in from being a situation where there was lack of capacity and too much demand to the exact opposite. And we didn't make any recommendations in that space, even though there was a couple companies, Titanium, Mullen as well, that we were following closely because looking at the conference calls and then talking to management, it was quite evident that after the big push with respect to increases in prices, that the situation was softening, and I would expect that prices have actually come back a little bit since then, in addition to lower volumes.
Yeah, and the valuation right now just seems fair. If you're not going to have much organic growth, it's only going to be led by those acquisitions.
Maybe
Plus
long
the
term,
fact,
it's
yeah,
interesting, but
there's
yeah,
some leverage here, so I wouldn't expect any acquisition in the near term. They're going to need that free cash flow to start paying down debt. Again, as we say with many of these companies, debt's more expensive now. So
hmm
you can have some EBITDA, but that interest expense is real there, and it's squeezing profit margins on a lot of these businesses. So we'll continue to monitor. Certainly not a terrible company, but we'll continue
no,
to monitor titanium.